Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our belated EIA show, and so we have some updates for some of the numbers that we normally don't have, which is good. Give you a more up-to-date view on especially Singapore and Europe. And we're going to look at, break it down into our normal, with the first part being more of a global view and how the U.S. kind of fits in that on the summary level. Then the deep dive into U.S. demand, U.S. flows, what's happening within just, inherently how is demand setting up. And then segment 3 is going to go abroad. We're going to look at Singapore, Asia, we're going to look at Europe and try to see how are things moving about, because we continue to see a movement of Asian product into the U.S. markets. So the one thing that just to kind of kick off segment 1, we just want to continue to look at what is happening with gasoline, because this has become a big focal point for the U.S., especially after Colonial. So we had a small build of about 1.5 million. It was driven by Pad 2, which is interesting because when you look at Pad 2 and Pad 3, I would have expected a little bit more of a pivot from one to the other. But then when you look at the demand cycle on the way the numbers are being calculated from the EIA, it seems that there is a bit more residual. And if you remember last week, we had highlighted that the EIA things were going to clear themselves in different ways based on the way the EIA calculates gasoline implied demand. And when we're looking at it, the view was that we were going to have a big shift down, or it was going to be two steady moves lower before we get kind of a normalized number that will be about 8.9 or so, maybe closer to 9 million versus what we're currently seeing. So based on what happened this past week, it looks like we're going to kind of get that steady move down over 2 weeks versus the big pivot lower and then the bounce back up. So it just kind of streamlines things a bit. And the reason when we look at this, you're starting to see some of those movements where Pad 3 is essentially saying we're caught up. Everything is now in the pipe. It's now being pulled through. And a lot of that is starting to show up in Pad 1, where you had a draw of 330,000 in Pad 3, but a build of over 2 million in Pad 1. So that was where we started to get this shift. Now, when we look at blending components actually had a build of 119 million, which is why not 1.19 million, which continues to drive up, which is kind of that concern. But when you look at the EPA waivers that were extended for the areas that impacted Colonial, it makes a little bit more sense, because you're going to try to sell really the cheaper gasoline because it's more expensive to make summer grade or things that are going to fall outside the waiver. That it just makes more sense. So that's why we'll start to see blending components draw down a bit. But when we look at gasoline, so it's 8 million below the 5-year average. But again, when you think about how the 5-year average has shifted because of 2020, things normalize a bit differently. And then when you look at blending components, it's only 4.3 million. But we'll talk about some of those caveats when we get into segment 2. Imports dipped a bit by 101,000 a day. It's now below 1 million at 932,000, but based on what's behind it, we're going to maintain some of these levels and actually go back up. It's just a matter of, as we keep saying, this timing delay, because we had Pad 5 that had a small dip, Pad 1. But when we look at the 5-year average, we're still 59,000 over the 5-year. We're 93,000 over the 5-year in Pad 1 and 30,000 in Pad 5. So that's going to continue to be kind of that nomenclature of, well, when is it going to come in? How is it going to hit? And then when we look at just some of the data sets, so U.S. imports of gasoline from Europe rose to their highest level in 3 weeks for the 7 days ending May 27th. So we're actually not seeing all of that come through right away. Gasoline imports increased to 460,000 barrels a day, the highest since the period ending May 6th. So again, that's that more behind it, with one cargo of with ultra low sulfur diesel that's also arrived, which we'll talk about. But the transatlantic refined fuel flows, so we're going to talk from Europe to the U.S., mostly gasoline and blending, hit 3.51 million tons in May, which compares to 3.49 million tons in April. And that's where we're now going to start June really strong. And depending on how the numbers look, it's going to maintain how quickly do we see more behind it. So far for June, 10 tankers have already sailed with 363,000 tons, with another 19 behind it, with which comes to about 755,000 tons. So we're already seeing kind of that strong start. And then based on what spreads look like, which the ARB remains open, we're going to continue to see more coming from the European markets into the US markets, which is going to keep that import level elevated. So then when we look at this a bit differently and we look at just pad 3, you can see that we had that massive build that happened from the beginning of March into essentially peaking in April, and now we're starting to come back down. Some of that is just, again, that marriage of, where a lot of the refining is, how are we moving that up? And that's why when we look at the yield, so right now the production shifted up a bit to essentially the peak that the refiners can really maintain of 64.2% target on gasoline. So this is one that is going to remain elevated. It's just how quickly can it get moved through the system, which is why we continue to see those movements. Now, pad 1 had that build, still falling outside the 5-year average in terms of the cloud, but the rate of change is starting to catch up a bit, and we're expecting to see a little bit more normalization as we come to the other side of the colonial shutdown. And then when we look at the gasoline inventories, this is where we're saying that everything has kind of gone flat. Now we're starting to come back up, but when we look at that average, we normally get that drawdown at just because we come into summer driving. So you have to think of what normally happens in the summer. We drive more, we draw down inventories. So we want to see the inventories come down. The question is going to be, what is the rate of change and how quickly are they falling, which is why we always look at the aggregate on the different impacts to what is going to happen with gasoline. So then when we look at U.S. oil and product total storage, you can see that things are steadily moving down a bit, but again, there's been no real acceleration on the rate of change, which is then when we turn to Europe, where Europe had a build in both oil and products. The U.S. had a build in products, a draw in oil. This is where we keep coming to this kind of balanced approach where we're not really seeing the types of draws that we were hoping to see so far, just based on what is being backfilled coming from Asia into the U.S. markets. So then when we look in, or I should say Asia into the Atlantic Basin. So when we look at USW, the crude futures curve, here you can see now we've actually shifted everything up because we're in such steep backwardation that when we look at what's happening through 60, I mean you were trading above 60 well into 2022, and then we're well into above 55 well into essentially 2025. So this is just going to help incentivize additional investment just based on where the things are starting to shake out. Now, this is not predictive. The curve is never predictive. I'm not saying it is, but it is a certain amount of guidance to where there is expectations for future oil prices, which then will start to enable sanctioning of offshore projects and things that are going to require more a longer lead time, but need a certain elevated price to incentivize the investment. But then you'll have the energy transition. But based on the view that there's going to be this massive surge, but again, that's where we get this conflicting view, because there's a belief that there's going to be this huge pickup in demand, but we're not seeing that play out in the physical market, especially things that, or I should say cargoes that sell into Asia, which is why the Asian component remains, I think, the biggest headwind in terms of how quickly do we get back to some sort of normalcy as OPEC brings back new production, which we'll talk about in segment 3. And this is really what is hindering that. So we can see Europe has come down. We didn't break out the different countries because they've all fallen below their levels that they need to see to reopen. So the reopening is already in progress, especially specifically in Europe. So that's why we're looking at where there's some residual issues, which is really in Asia. Again, India is now past the peak, which is important to see how do they react now in June, because we already know what happened in May. May was very slow, slower than April, which in April was, slowing. So then the question is, how much does Malaysia impact? Because Malaysia is actually a fairly big buyer of high octane gasoline. So how much does that put back into the system when we start talking about Singapore and some of the spare capacity that's going to be moving throughout the system. Then when you look at South Korea and Japan, this is that stickiness that we continue to see. Now, Japan's starting to make some headway, but South Korea just is holding within this level without really able to get over that hump. So now Vietnam is going to be one to watch, but all of these are smaller entities. Obviously none of them are a China, a US, or an India, but China's been slowing as well, more for economic reasons because they've been open the longest. I mean, we've seen them. They've been out of the COVID lockdowns longer than anyone else, and we're still not seeing the same type of consumer activity that I think we would like to see given what they're putting into the market, what they're importing, and that's going to be the one to watch because India and China, two of the biggest importers in the world of crude, is going to become kind of, all right, well, how much is coming into the U.S.? If the U.S. keeps getting stronger, is there more than enough product to meet it? And what happens with some of these cargoes, which will go into a deeper dive in segment 3. So when we look at crude stocks, we had a draw of 5.08 million, which takes us 22.6 below the 5-year average. And we had a small draw from the SPR, which is going to continue at 5.73. And the biggest draw came from Pad 3. So Pad 3 had a draw of 5.64 million, but it's still 8.5 million above the 5-year average. So you're seeing refiners trying to essentially draw down this excess in Pad 3. And that's where you're going to get this balancing act of trying to import while trying to, because they need a certain blend. They need a certain API level, which is typically between 33 and 34 API crude. And the U.S. is producing at something closer to the essentially the upper 40s, mid, let's say 42 to 48 API. So they need the blend to bring that down. So it's a matter of how do they balance between what's in storage and marrying it with what's coming from abroad, which is why we still think that you're going to get a steady increase in imports, which is going to slow some of the drawdowns that we've seen so far in Pad 3. While we're going to get a big import hit again into Pad 5, but we'll talk about that in a minute. And then the production, again, this is a calculated number, and that's why we were talking about March. We were talking about some of the other periods where this is using a rig model and not a frac spread model, and that's where we're much closer to that 11.1 versus 10.8 on our way to really 11.2, 11.3. So then when we turn to just looking at land storage in total, so stockpiles rose by 3.2 million to 657.7 million barrels after falling 4.3 last layer. That's 4.3 was 2 weeks ago. 3.2 million build was last week. And this is where we continue to see kind of this competition of kind of when you get a draw, then you get a build, and it's the East of Suez continues to track 2020 numbers, which is the concerning side because we were hoping to see East of Suez start to come down, but instead it continues to build higher. And then West of Suez is this balancing act because even though the U.S. had a draw, the ARA or Europe had a build, which is kind of offsetting. And then when we look at what's happened East of Suez, we had another build, which again is keeping us from getting back down below the number that is constantly quoted as the 5-year average. But what is the right 5-year average? We had that conversation last week. So you can see that we're still well above where we should be as we start to see some of the movements come from floating storage into onshore storage. So then when we look at offshore storage, West of Suez continues to draw down. We had the U.S. Gulf fall, we had Europe fall as a lot of that went onshore. And then West Africa, we had some deferrals. So instead of it sitting on tanks, it essentially is just going to sit behind and they're just going to kick it out to another month. East of Suez had a nice drop as we started to see some of that pull through. It's still above the 5-year average, but again, it's coming back to where it was in 2016, which was kind of the end of that huge surge that we had following the breakdown of the relationship in OPEC following 14 into 15. But when we look at where it, technically should be, we're still obviously elevated. So there's still more work to do, which we're going to talk about in segment 3, looking at, what's in transit, what's in storage, and what is, where is this going to go overall in terms of what pricing is telling us. So then when we look at fuel demand, China has stopped reporting, or it's becoming difficult to pull down. And we've actually had a small breakout of COVID in Guangdong across 4 cities. We talk about that in the econ show on an economic level, but when we look at it from an energy level or a consumption, there's been a little bit of a hit. It's not anything crazy. It's not like we're coming way back down, but you can see that there's that friction point. Europe is getting back to that normalcy level. We saw that big reaction. And now, as we were saying last week, now that we had this spike, we think that we're just going to go sideways a bit. Rest of Asia has what we were saying, where it was just going to flatline as people wait for the reopening. And as things had gotten a little bit better in Japan, they're actually getting a little bit worse in Malaysia, and that's that kind of back and forth, which is keeping us at this kind of flatline level, especially when we look at India. Now, North America is technically mislabeled because this is looking at the Americas. And when you look at Latin America, that is the biggest overhang in terms of what is keeping that road fuel demand normalizing, as Brazil, Argentina, and now Colombia are seeing some of that friction points, with Mexico actually seeing a fairly big recovery. So Canada's still slow. U.S. is, and again, this is looking at peak congestion. U.S. is still off peak congestion. So that's where we still have yet to see some of this normalization, which is why we continue to talk about our exports of gasoline, which typically go into Latin America, are just not seeing the same demand pull, but we have a fairly strong number in the U.S. So you'd rather sell it internally than externally, but then you have to worry about RINs and blending, and this is when it gets fun and complicated. Now, when we look at crude oil, excluding the SPR, this kind of gives you an idea of where we sit across the last 29 years. And the reason why, typically when you think about storage, and it goes against what is happening in the refiners. And we've actually seen refiners close, or over the last 3 years, more slated to close over the coming 3 years. And that's technically going to require less crude, more product storage to kind of buffer. So it'll be interesting to see how this adjusts, and the SPR continues to sell down in order to kind of finance fixing it, adjusting some of the metrics. So that's where we're going to continue to see some of these shifts, as the SPR is slated to continue to sell out into the market. Then when we look at, PADD 3, this kind of gives you an idea of how elevated we still remain, even though this has been the biggest driver of drawdowns within the U.S., as PADD 3 continues to try to work through some of this excess, as exports fall under additional pressure, which we keep talking about, because when you look at spreads, it's really difficult to get movement from the U.S. into the market when you look at LLS versus Brent, Magellan East versus Brent, which again is going to hinder some of that flow into Europe, while we do have additional flow that has been moved into China. But we'll talk about that in segment 3 as well. So then when we look at Cushing had a small build, which when you look at the last 15 years is counter-seasonal, but we're still at a fairly low number. So when you look at what we've actually seen in terms of flows, Cushing had a build of 780,000, and that's only 8 million below the 5-year average, and that's kind of the conflict, where what we've been talking about is Cushing is just going to flatline. And as it flatlines, the trend is down, because typically it draws at this period of time. And the fact that it goes sideways, the comps are going to get harder. And that's going to show, I think, a less bullish number, if you will, as things progress through the remainder of June for the most part. Then when we look at imports had a big drop of 642,000. It was driven by PADD 2, PADD 4, and PADD 5. So PADD 2 had a drop of 302,000. PADD 3, as we were saying last week, we saw it being fairly steady, and it was up 68,000 barrels. So that's not too much in general. The one that we thought was going to have a drop but still remain elevated was PADD 5. So PADD 5 had a drop of 321,000. but that's only 11,000 below the 5-year average. Now, when you look at purchases, PADD 5 has actually been buying a fairly decent amount of Russian crude that launches into the Pacific. So this will provide a new flow through coming into PADD 5. So we expect to see PADD 5, PADD 2, and PADD 3 actually start to lift up, which will increase imports while exports stay fairly muted as we look at some of the different competitions back and forth in terms of exports versus imports. Then when we look at runs, we actually had a nice step up of 1.7%, getting to 88.7% runs in the U.S., which is actually right in line with where we should be at this point in time. So this is a nicer surprise in terms of pulling down additional crude. The question is, was this kind of that push up to fill some of the void, and then we'll start to see some normalization? Because this, we were assuming that 87.5 was going to be kind of that peak, and then we were going to play within that as we got through the first or second week of June, and then we were going to start to trend towards 89% utilization. Instead, we just started off June stronger. So this kind of pulls forward what we were thinking in terms of what was going to happen by week 2 of June into the last week of May, first week of June, which is a net positive for oil draws. But we have to see how it reacts with product, because you have to look at both sides of the coin. If you're drawing down oil but building product, you need one to offset the other, where you want to be drawing down crude and either building slower product in order to see those draws continue to whittle through, because you're just taking a product from one and turning it into another. And if they equal out or are net positive, then you're really not working through the excess inventory that we continue to see. So when we look at implied demand, this is what we were talking about with different flow points. So gasoline had a drop of 333,000 barrels a day, going from that 9.5 to 9.15. Now, our assumption was that you were going to get a bigger drop after you had 2 kind of steady increases. We were going to get a bigger drop down. Instead, this leaves us open for one more move lower before we start to see some of the stabilization going through the system. Disti had the normal seasonal drop, even though of 648,000 barrels a day. This is what normally happens, where you have truckers that go home, then they have a big drop. We're going to get a big increase. Jet had a small increase of 42,000 barrels a day up to 1.4. That's right within line on the 5-year average. And then Resid had that small increase of 199. Now, the one thing that we're expecting for next week is gasoline has another move lower, jet fuel has a small move lower, and Disti has that spike up. So net, we shouldn't have all that much change on the total number when you look at just flows, when we talk about gasoline, Disti, jet, and Resid. So that's why we look at that in general. Then propane continues to see a strong demand, where it was only a decline of 27,000 barrels, which we think is going to continue just given the demand cycle that we continue to see into not only residential but also commercial, which we'll talk about again in segment 2. Then when we look at U.S. Floating storage, it came down. But based on what we're seeing in the purchases that are coming through in general, we expect to see this continue to drift higher, and that's where we had a higher high, we had a higher low. And it's just going to continue the trend. If we look at the 5-year average, we typically go and we peak into June, into the end of June. We're going to see a similar trajectory. It's just going to be obviously at a much lower pace because we have so much spare capacity in just those specific tanks in PADD 3. So as the U.S. doesn't import as much into PADD 3, though we will import more specifically into PADD 5, that's again leaving more in the market, which is why we continue to see some of the struggles in West Africa, even though the U.S. did see an increase in Nigerian barrels. And given some of the pricing metrics, we expect to see some of that accelerate over the next month or two, just given where the differentials are and how pricing remains supportive of pulling down West African cargoes. So then when we look at imports, this is showing that we were expecting to see more of a seasonal increase, just given where actually runs showed up. So the fact that runs increased and yet we didn't really see all too much adjustments in the imports speaks to how I think we're going to get that backfill of those imports coming into the market in general. And when you think about runs, PADD 3 is, in terms of runs in general, the biggest increase in runs was in PADD 2 of 208,000, where PADD 3 was only an increase of 98,000 barrels a day, still leaving us well below the 5-year average. So PADD 2 is the one that's really driving the show, which is getting us closer. And that's some of the things that we think will switch over time. Not to say that PADD 2 will come below the 5-year average, because it won't. But PADD 3 is going to be that one to kind of climb the ladder over the next few weeks. And then when we look at PADD 2, again, this is that timing delay. So here is where we think that, given the operations that we've seen on the refining side, this is going to pick back up, and we're going to see this spike back to above that 5-year average. And this is looking at the 29-year average side. So here you can see that we're trending in the right direction. And then when you compare this just to the 5-year, we're kind of right in line and seeing some pretty steady increases. And now at this point, we think it's just going to go more sideways. But again, that also normally happens. So right now, just based on what we're seeing in the market on the refining side, we're going to see a pretty steady sideways move, which will be in line with the seasonal averages. So the question is going to be, how much of those imports saturate some of those potential drawdowns, and how quickly can we start to see some of that normalization on product? Because as we said last week, distillate starts to build, and now we're starting to see that disty build. And the question is going to be, how quickly can we draw down that gasoline, as it continues to come and we continue to import it, offsetting some of those drawdowns. So we'll talk about that more in segment 2.